The Central Bank of Nigeria says 30 banks have met the new minimum capital requirements under the ongoing recapitalization program, while 3 lenders are undergoing verification ahead of the March 31, 2026 deadline. The regulator disclosed that 33 banks have raised fresh capital through rights issues, public offers, and private placements since the exercise began in 2024. To unpack this, first I had an interview with Stanley Onora, and of course we'll be bringing you that after now. But for now, I have Ayokunle Olubunmi, Head of Financial Institutions Ratings at Agusto Co. Thank you so much, Ayokunle, for joining me today.
Good morning. Thank you for having me.
All right, I believe you monitor this exercise closely. What's your reading of it so far, and what are your key takeaways from the recapitalization exercise? We're talking 30 already completed, and we have 3 that are still, verification is ongoing.
I think the first thing that jumps out at anybody is the attractiveness of the banking industry to the investing public. At the beginning of this exercise, about 4 trillion was expected to be injected by the banks. And even the banks have even surpassed that. And except for just a few, for the 3 foreign-owned banks and even GT Bank, all the banks raised those funds in Nigeria to remain attractive to Nigerians. I think the second thing that we can also take away from this exercise is the importance of good corporate governance, disclosures, and strong relationship with the investing public. Although you can say that the banking industry, the banks are not perfect like any other organization, but if you look at among all the corporates that we have in Nigeria in terms of disclosures, corporate governance, and even strong relationship with the investing public, you see that the banks have actually even maintained these over the years. And I think we also need to salute the resilience of the banks. So far, except for one bank that is emerging not really because of this exercise, none of the banks is actually even merging or being acquired because of this recapitalization, at least among all the banks that we have currently now. So it shows that none of the banks gave up. They pushed on. Even imagine some raised over 300 billion, right, during this particular exercise. And I think another important thing that we can also take away from this is also the depth of funds that we have in the Nigerian market. And I think the CBN realized it. That's how they mentioned that the banks should raise this much. Like I said earlier, over 4 trillion already raised so far, right? And even all the banks have been able to absorb that.
Oh, that's quite interesting. What more do we need to know about this exercise, especially for the remaining 3? Where are they? What's going on? Are you confident that they will meet up?
Like you mentioned earlier, those 3, they are not in the markets to raise funds. They're already done with the capital raising. All they are doing now is trying to even undergo regulatory scrutiny, means providing all the documents, showing the sources of funds, and providing clarifications for those particular funds. I'm confident that before the end of the month, right, we should actually even have clarity on where they stand. And I'm confident that given that they've raised the funds, even if they've not been able to fully explain that to the CBN might actually even be willing to even give them some extension. And remember, when it gets to verification, it can't be done in a few days. Don't recall that in a few weeks ago, the CBN mentioned that it was 20 banks that they are done with the verification. Now, they've done 10 additional banks in less than 2 weeks. So in the next few weeks, we'll actually even know where those 3 banks stand.
All right. So from the process, are we seeing a distinction among banks, whether you're looking at it in terms of authorization, in terms of chair, or even public status?
This exercise, what it has done is it has actually even showed the importance of scale, right? Now, all of the international banks, none of them have shareholders' funds below 8 trillion. Some even have over 2 trillion as share capital, right? And if you compare that one to the non-interest banks, right, that actually even have some interest bank and even some regional banks, some of them, their shareholders' fund is actually even less than 100 billion. So what you're saying is that scale is actually even showing, right? And we are going to see that one in the next couple of years because with a larger capital, you see that the single obligor limit will be higher, the ability to lend will actually even be bigger, and even the buffer to absorb risk will also even be different. And don't be surprised that it might not be a surprise if some other banks, right, come into the market later on to increase their own capital buffer, because what we are saying is that scale matters. And that's why you see that some non-interest bank, even though they've already existed, they've exited the regulatory minimum, a lot of them are still in the market trying to raise capital either in forms of AT1 or Tier 2 capital, just to ensure that they have that capital buffer. But the way we are going, the next couple of years, we're going to see the importance of the different skills of the banks.
Well, it's not enough to have the war chest. What's important for us is how the funds are being deployed thereafter. I know you've started talking about, how that it provides buffer and all of those, but the interest for us is catalyzing growth in the real sector. Is that a given?
With this level of capital that the industry has raised, the industry doesn't have a choice. You have to lend. Because now, recall in the last couple of months, the discussion is how can you raise capital? In the next couple of months and years, the question is how much return can you deploy? Can you actually generate and even provide for your shareholders, right? And also, remember that as a bank, there's a limit of what you can invest in government securities. And even now that rates are actually tapering down, you will see that it's going to be difficult for the banks to pack all the funds in government securities. They don't have a choice, they have to even lend. And a lot of banks are looking at different sectors. And interestingly, we'll see more sectors that they're going to lend to. We're even going to see more products that the banks will introduce just to see how they can even support the real sector. Should I say, luckily, compared to all the things are not perfect now, but if you look at where we are now compared to where we were 2 or 3 years ago, the economy is relatively in a better position. And then the risk profile in the economy actually even reduced a bit. So I'm confident that the bank, only a lot of banks will lend and support the real sector.
All right, thank you so much, Ayokunle Olubunmi, Head of Financial Institutions Ratings at Agusto Co. Thank you for your time and thoughts on the show today.
Thank you for having me.